Hi, everyone. I'm Rick Bensignor, and welcome to this week's In the No Trader Show on StockCharts.com. Let's go through our agenda for today. We'll talk about upcoming public appearances. We'll look at the macro sector S&P relative movement, then the S&P itself. And this week, we're going to focus on the semiconductor piece of the market. It's done real well, and I want to look at some of the bigger stocks in the area, both semiconductor and semiconductor equipment names, because a lot of people feel like if these are moving higher, it's a good sign for the whole market. So we'll take a look at those charts and see what they have to say. So as far as upcoming public appearances, as many of you know, in fact, I sent out an email yesterday to In the No Trader clients just because I was on Bloomberg TV this morning. You should be able to catch clips of that. If you go to Bloomberg.com, put in my last name, Bensignor, and do a search, they probably have some of the 30 minutes or so that I was up talking about a variety of different markets and some new ideas for 2020. So I will next be on Wednesday, January 22nd at 2:30 p.m. talking about futures markets. In February, I will be at the Orlando Money Show speaking on Saturday, February 8th at 8 a.m. Again, this is a free show. Anybody in the Orlando area or who wants to go to the Orlando area, I highly recommend this show. There are dozens of speakers. The event is free. It goes 3 days, if I'm not mistaken. I think it's the 6th, 7th, and 8th. And they set up a special link. If you go to inthenotrader.orlandomoneyshow.com, you can sign up, and it will get you registered for everything you need to know. And that's that. So let's go take a look at the macro sector, see what's gone on in the last week. Oh, before we hit that slide, just a reminder on how to contact me. I am Rick at inthenotrader.com. Our website, inthenotrader.com, gets hundreds of hits a week, and there's lots of videos and clips up there that we have, as well as information on how to become a client of The No Trader. I publish that report every Wednesday night for individual investors, as well as people generally who are, let's say, financial advisors. And we give new ETF recommendations every week, review everything going on in the market as a whole, and also go over all the open trade recommendations that we have. So also as a reminder, once we get you into a trade every week, we write about it until we get out of it. So you're never left hanging there. There's follow-up to every trade idea that we do that is still an open position. Okay, let's take a look at what's going on in the S&P as far as the 11 macroeconomic sectors are concerned. On the left side, we have year-to-date through last Tuesday. On the right side, we have year-to-date through yesterday's close. So we can see the difference between what's occurred in the last week. We highlight those sectors that have moved more than 1% relative to the S&P. With dots, green dots means they have increased by 1% or more since last week. Red dots, they have declined by 1% or more. So only 3 have moved in the last week. That's not a huge surprise as we get in towards year's end, and a lot of the price movement's been done as far as sector allocations. Technology, the leading sector this year, actually had one heck of a good week. As of last Tuesday, XLK was outperforming the S&P by just over 17%. It is now by almost 20%. So a pickup of over 2.5%. That's 250 basis points in a single week as far as outperformance. Again, showing itself to be the best sector of 2019. So if the S&P, I'm guessing it's about up 26% or so, give or take for the year, add virtually another 20%. So if you've been in the technology piece of the market, and more specifically XLK, the ETF that tracks the S&P 500 Technology Index, you have picked up an extra 20% by being in that sector. Losses this week were consumer staples. They had been up about 0.75% versus the S&P. They are now down about 90 basis points, almost 1%. So that dropped about 1.75% or so in the last week and put it into negative territory. So it's actually underperforming. And REITs continue to have a problem. Again, we talked about this last week and actually for the last several weeks. Back in, I'm guessing, September or so, REITs were up about 10% better than the S&P at the time. They have gotten crushed and now are down almost 3%. So you were talking about a massive, roughly 1,300 basis point move. That's been a bad move in the real estate department, we'll call it, in the last few months. And there, if you had not shifted out of your allocations into the REIT sector, it has hurt you quite a bit. Energy remains the worst sector of the year. It's down almost 18% relative to the S&P. So it is up on the year because with the S&P up 26%, this is still up on the year. But again, energy remains the worst place to have been, followed by healthcare. But healthcare has dramatically improved as of recent. So it's still a loser, but not nearly as bad as it has been. All right, let's take a look now at our charts. And let's start off with the S&P 500. This is a daily chart. We'll look at both daily and weekly charts of the S&P this week. So you can see that after getting the 13 signal, so that's the DeMark sequential signal suggesting some type of exhaustion of trend. We basically went sideways for multiple weeks until now over the last several days with the China phase one trade deal seemingly complete, although notice that neither the US or Chinese presidents have signed it. Trade negotiators have signed it, but the presidents themselves have not. The market has taken this as good news, expecting far better economic news to come because of this trade deal over time. I'm not sure that's the right interpretation, simply because what has been approved in this phase one trade deal is really not very different than everything they've discussed in the past and essentially had already agreed to. The biggest issues between the US and China still have not been addressed, most importantly, intellectual property and China's continued stealing of it and unwilling to do anything about it. And I think that keeps this China negotiations open for months, if not years to come. And again, although the market has taken this as a good sign, it's not a bad sign, and I certainly understand the buying that's coming from it, but it may be, the S&P is pricing perfection in, and some of the economic numbers don't necessarily agree with that going into 2020. Nonetheless, market made all-time highs this week and continues to push higher. And you can see here that even today, we slightly took out yesterday's high, so we've even pushed to a new all-time high today. Let's take a look at a weekly chart of the S&P. And, to me, this stands out a little differently simply because this week represents a setup 9 count. That means this is the 9th week in a row that the close, and we'll assume that Fridays between now and Friday's close, we don't fall apart. This will be the 9th week in a row that the close on Friday will be above the close from 4 Fridays prior. And a lot of time, that's part of the DeMark sequential model. And a lot of times when we get to those 9 counts, they're temporary highs. Sometimes they end up being even much more than temporary highs. But here, let's take a look at some of the other 9 counts we've seen in the last year and a half or so. This 9 count here was good for many months. There's a 9 count here that didn't do anything. There's the 13 here, which is the conclusion of the 9 counts, just with different counting. That actually was good and notified you very well in the early part of the summer that that was not the time or place to be a buyer in the uptrend. We played multiple times with propulsion down levels that never got qualified and confirmed, which keeps things on the bullish note. Now we've gone 9 weeks in a row. Ultimately, I do think in 2020 we're going to see 3336. That is a minimum upside target at this point with the S&P near 3,200. It's only a few percent higher than that. So I think that's, no, it's not a stretch to think that that's where we're going to go. Also, importantly, is the fact that this week, because of the continued strength, this dark purple line is the bearish propulsion momentum level that has continuously moved higher as of recent, and it was 3,027 last week, 3,006 the week before, so now it's at 3,049 and a half, just about 3,050. This becomes a warning sign for us. If this gets broken on Friday closes, especially if the week before it breaks it was an up close, then that makes me more concerned. You can also see that going into January of next year, the bottom of the channel line basically is going to be at the same level as where this propulsion level is. So as we start off the new year, that makes this 3,050-ish level even more important, because if you break that, you're not only breaking the propulsion level on the downside, which kicks in a kind of a bearish signal, but you'd also will have broken the uptrend line that goes all the way back to last Christmas's major bottom. So that to me is the level that somewhere near 3,050 or so is going to be the key level that we're going to focus on going forward. And as long as we stay above that, we're okay. If we break beneath it, and how we break beneath it will determine the degree to which we start hedging up books. So that's my early call here on the S&P, at least for near term, as 2020 develops. And if we break above 3036, we'll start setting up new higher targets. Now let's take a look at the semiconductor place. So we have about half our show left, and we'll be able to look through a bunch of charts. So we're going to start off with, these are going to be weekly charts by default. What I am going to include on them is the sequential model, which obviously are the numbers that count above price bars. Propulsion targets, which is more, whereas the 13 count, the sequential model tends to be a counter trend type signal. In other words, in an uptrend where it's a lousy time to buy, propulsion actually gives you signals of when to buy in an uptrend, saying that the physics behind the move have enough thrust to create a move higher. So more recently on a stocks index, the semiconductor index, which is the benchmark index for semiconductors, back in, looks like towards the latter part of October, we broke properly above these little green triangles that said we would get to the blue triangles, which we did just a couple weeks later. Getting through those will suggest that we could get as high as the full propulsion exhaustion level of 1970 off of the current 1819 price target that we have now. So there is a little stall here against another propulsion level, a more recent one. But in the bigger picture, we'd say that 1970-ish or so is the next kind of bigger upside target. On the downside, notice that a few weeks ago, the lows made were against the bearish propulsion level. We closed above it, so no problem. We never closed beneath it. If we had, it would have suggested that we could go down here, if not all the way down here, but it rejected it. That kept things bullish, and we are on all-time highs in the semiconductor space. So in the sense that if you want to watch the semiconductors for a sense of what the market could do in general, and not that the semis in any way represent the market, but if technology is kind of the key part of the market, the way 50 and 100 years ago when Charles Dow created Dow theory and said that you needed the transportation sector to confirm what the industrials were doing, I'm kind of a believer that you want to see semiconductors confirm the up move in other parts of the market. And in this case, it is. You can see the slope of both the 50 and the 200-week moving averages are still positive. The slope flattened out. Actually, fourth quarter last year, you lost some slope, but it's picked up again. So as of now, the semiconductors still look good in a general sense, and that's a good thing. So besides looking at the SOX index on its own, let's also look at the SOX index versus the S&P. So let's do that and see what that says. And again, we stick with a weekly chart, and you can see that, again, in relative performance terms, the semiconductors have still been a shining star. So not only are they on all-time highs, but versus the S&P, they're on all-time highs, which means in relative performance terms, if you had been in semiconductors, you would have done much better than being in the broad-based S&P itself. Of note, however, is that in the last couple months, we're seeing a couple of upside exhaustion signals appear. We have the 9 and 13 count here, which came in about 2 weeks before this decline into November. Not any material decline, but we're getting another 13 here now, which means to me, it's harder to first put cash into the semiconductor space on a relative performance basis to the S&P. Doesn't mean it can't move higher. It means you have far more risk in doing so. So I much rather see a pullback in the ratio, and this literally is the price of the SOX index divided by the price of the S&P 500. So right now, the SOX index is trading at just about 57% of the S&P. I'd rather be buyers. You know, if I still like the idea that over time this is going to outperform, but I don't want to chase, closer to 55% or even 53% or so are better places to get in than chasing after it here. Despite the fact that MACD shows there's improvement, etc., I know, having used this model for years, that it would imply that the risk is higher, well higher than normal, to first put cash to work in a play of the S&P, of the semiconductors outperforming the S&P. The other one I want to look at before we get to some individual stocks is the semiconductor index versus the XLK. So instead of looking at versus the whole broad market, let's look at how semis are doing versus the actual technology index, right? So XLK, of course, is the ETF that represents the entire S&P 500 technology index. So you can see also, going back now almost 3 years, there are multiple 13 signals. Each time you get one, you're very close to some type of pullback. Sometimes they're short-lived, sometimes they last several months. You can see, again, I'll highlight them. This was pretty good for several months. This was pretty good for several months. This was pretty good for, I don't know, a good half a year, if not more. This wasn't much at all, a couple of weeks. This was a couple of sharp weeks down. And we're still kind of within the context of that. We'd have to get above a ratio of 20.375. So in this case, it's the SOX index trading at 20 times the price of the XLK. So if you get to 20.375 up to about 20.65, if you can get through there, then we'd expect it to go higher. So same type thing here. I'm not necessarily jumping after semis here in relative terms. Doesn't mean you don't want to own semis. It just means it may not outperform their benchmarks. The other thing here of note is, let me just throw a straight line out from, here's where all-time highs is, this purple line I've just put in. So even though the semiconductors versus the S&P have plowed to all-time highs in relative performance terms, you'll note here that semis to the XLK has not yet broken out to new all-time highs. So something that also says there's a little more weakness here. There's a little more underlying concerns. If this breaks out to new highs, that's better. Let's now take a look at, let's see, did I set them up here? No, we'll just use the same chart. Let's look at some of the bigger ones in no particular order. We'll start with Intel, ticker INTC. You can notice that we're still playing in and around the area of the all-time highs from 2018. We tested those in April, or it was April of this year. We went slightly through it, but then came right back down to the bottom of the range. So you can see there's somewhere kind of what we've defined here in horizontal purple lines is the trading range that Intel has been in for a good year and a half or so. It was marked with the 9 and 13 signal right on the top. There was another 9 signal here. So I kind of need to see a clearer breakout to the upside before buying Intel. Otherwise, I'm somewhat concerned, that this too could stall here, and that you'll get at least a chance to buy it lower than here. Here, if you look at the 50-week moving average, it's very close to the propulsion exhaustion signal on the downside. I don't know if there's a reason for us to think that right now this is going to lose over 10%, but at a minimum, I'd probably wait till at least 55-ish and get something near here where the propulsion momentum level comes in before going after the name, or wait for new highs and let this clearly break above what is the all-time high here, which is 59.59. Notice also the MACD is starting to stall out. And so, that's a potential concern too. So here's a name I just kind of rather wait to buy. Let's check out what's often been a high flyer, which is Nvidia. Had troubles clearly in the fourth quarter last year, where the stock went from 280-ish all the way down to, 125 or so. So it cut itself more than in half. Pretty good look here, came right to the 200-week moving average in the middle of this year. Rallied, pulled back, gets a 13 buy signal. This is downside exhaustion. The numbers are coming underneath the price bars, the exact opposite of when they're coming above the price bars. This now looks for downside exhaustion. So this was a great signal here. We've moved up nicely. You're into the countdown portion. I would say a target is anywhere first up at about 238. And then secondly, it's actually all-time high. So those are the two targets in between. MACD is spread out nicely. There's good momentum to the upside. Again, if you like the space over time, that doesn't mean you can't buy some, but leave some powder dry for pullbacks. 167-ish right now would be the area. It would be the first support level the way I see it. Micron, ticker MU, has not gotten up to its all-time highs. Right, so again here, this area and here are the all-time highs. The 13 count last year is, peaked market, so on a slightly higher high than what had been the earlier first quarter high in 2018. This gives you an upside exhaustion signal. Comes down, tests the 200-week moving average on the Christmas low last year. Rallies, pulls back, stays above the 200, and now has progressed. Now, I do have some concern here about the 13 count that showed up. There's resistance. Notice this week's high. There's a resistance level at 54.28. This week's high is 54.30. It's already over $1 off there. That's the risk level. That's where this 13, if you properly get above it, says disregard this signal. Well, right now it went right to that level, hasn't broken above it. Anywhere from 54.30 to about 56.07 is going to be resistance. Hurdle those, then you can expect to test the all-time highs, and possibly, if semis just kept on trucking into next year, ultimately you'd have a target up near 84. Otherwise, on the downside, look for support near 45.25, and then the 50-week moving average, which right now is about 42.5. Okay, Qualcomm. Very different looking stock. This has had its problems over times. Now, you have to go back to 2000 to find its all-time high. So let's go throw a line out from there and then zoom things in. So recently we get the first 13 upside exhaustion signal in quite some time. That was last time we had one was back in July of 2017. So first one in 2.5 years or so. That peaked the market this year. Again, that signal represents really bad time to be a buyer in an uptrend. For those who are aggressive traders, they'll often take this signal to be a good time to be a seller. This pulls back, gets a non-qualified and confirmed propulsion sell signal that does go to the exhaustion level, turns around, has kind of come back. At this point, knowing that all-time highs are just about exactly at 100 level, the stop out from this 13 signal is up at 104 and change. With a stock trading 88, you're not going to get stopped out. You're not going to get rid of this resistance till you're above 104 and change. That's a long ways to go to first wait to get in. Therefore, I'm just going to look for pullbacks to play. And given the opportunity, if this pulled back for whatever reason in first quarter next year, we get down to 76-ish, I'd be a buyer. Secondarily, I'd use the 50-week moving average also, and as it's positively sloped, it probably will move up over time as we drop out prices from 50 weeks ago that were lower, so we should have positive slope on the 50-week. So if in the first quarter you get your 50-week anything even close to the 76-ish level, that would probably be a place that I'd be willing to buy Qualcomm. Broadcom, ticker AVGO, last week made, I believe, let me just pull in data from, all-time highs. That 9 count again sometimes indicates a short-term pause of 1 to 4 weeks and sometimes bigger. So we've gotten through the propulsion exhaustion level. The full propulsion exhaustion level is up at about 376. So what's important here is look over the last month and a half. These little purple lines would be sell signals if properly exceeded. Didn't exceed it here, didn't exceed it here, and we're above it now. So this still has an upward bias. We got to be careful if we close back underneath right now, 308. If we do, look for 288. That would be a $20 decline. Generally, this still looks good. I like that MACD is positive, but look, I can't help. It's what I've done for a living for 25 years. I've been using DeMark models. You can understand why In the Know Trader was set up to use these models as one of the key differentiating factors of how we look at the markets, because we present to you a much better view of how institutions look at the market as compared to, let's say, a standard technician who's just using MACD signals or moving average crossovers or other things that are kind of out there as part of the general repertoire, but generally not what institutions are using to make decisions. This model is much more of an institutionally used model, and that's why In the Know Trader was created, to give you access to models that you would not normally have access to. And just as we kind of finish up here, the reason I use the chart system I do is simply because it gives me access to these models. There's only 2 systems out there that does. So, I mean, I love StockCharts for their charts, but unfortunately, I can't get this model on there, and that's why you're seeing them here. Otherwise, I'd be using StockCharts charts. But in order to get DeMark models, you need to have a Bloomberg system or a CQG. So you are looking at a CQG charting system here. So there were a couple other names I was hoping to get to, but we've got, I don't know, 30 seconds to go or so, and therefore we're going to wrap it up for the week. Have a good end of year.